Hello dear traders, my name is Elizaveta Belugina. I'm the head of analytical department at FPS, and we start our regularly weekly webinars on Forex market analysis. I very welcome you after the Christmas and New Year holidays. I hope you had a great time and I wish you all the best in the year of 2017. Good profit, good trading, and good mood as well. So let us begin with our usual agenda. We will discuss the outlook for Forex major currency pairs for this week, which has started today, Monday on January 9th, and will end on Friday, January 13th. So here is our agenda. We discuss how Forex market is positioned. We discuss what events lie ahead in the economic calendar. When we open MetaTrader, we open our currency charts, look at the technical picture, and then we summarize what we have discussed and name our trade ideas. So let's begin. As usually, I'd like to start with CFTC data. These figures and charts prepared by Commodity Futures Trading Commission show us positions of large speculators on the US dollar and other major currencies. As you can see from the chart on the left, the overall bullish US dollar position is now being rebuilt after investors had cut this position a bit in the middle of December. Now we see that US dollar net longs are rising once again. If we have a more detailed look on how other major currencies perform in relation to the US dollar and other currencies, we can see that there weren't many changes during the last week. The data was reported. The data is for the week which ended on Tuesday, January 3rd. There is some time lag, but still we can see some important trends in how the large speculators are positioned. And here probably the biggest change is in the British pound. We can see that the bearish sentiment about the British pound is increasing. The overall bearish position has increased and is rather big. Also, we see that the market is short on the euro, New Zealand dollar, or Japanese yen, but here we don't see any significant weekly changes. Also, I'd like to point out that positioning on such currencies as Australian dollar and Canadian dollar is close to neutral. And if we look at gold, here is a large bullish position, but no significant changes took place in the last week of this analysis. So what is the basic conclusion from this information? It is that the market is still bullish on the US dollar. Some correction took place in the middle of December, but now traders are slowly rebuilding their bullish bets on the American currency. And going further, let's have a look at the US dollar index chart. This chart shows us the dynamics of the American currency versus currencies of America's 6 main trading partners. Firstly, let's have a look at the weekly chart of this instrument. We can see that during the year of 2016, the US dollar index broke important resistance level in the area of 100 points. To be more precise, it's 100.50 mark. And then above this level is now acting as support. As long as the US dollar index is trading above this mark, the overall outlook for the greenback is bullish. But taking into account some fundamental factors, the odds are that we will test this support level once again. On the daily chart, we can see the picture in greater detail. We can see that the US dollar index broke below the short-term support line, which is in place since November of 2016, and is now trading below this support line. This support line has now become a resistance line and is going to limit the advance of the US dollar index on the upside. The main resistance is located near 103 points, and further resistance will be at 103.50, 104. Return above 104 mark will surely mean that the bullish trend in the US dollar is going to continue further, and that we will see further highs of the American currency. For now, we will have resistance at 103, and we remember that support is located around 100.50. These are the main levels to watch for the US dollar index. And even if you don't trade this instrument, US dollar index, still it is an important indicator of how the American currency is feeling generally at the market, because it kind of sums up the information on dollar's strength or weakness versus a variety of other currencies, and not just one particular currency like the euro or the Japanese yen. We know that the picture for these different currency pairs may be different, and if we have a look at the US dollar index chart, we can have a bigger judgment on the US dollar, and it is a valuable judgment, a valuable source of information for our Forex decision making. So we can see that the American currency has some barriers on the upside and on the downside. Perhaps I can say that the obstacle on the upside is closer to the current market price, and there is more scope for the movement to the downside before we hit some serious support level at 100.50 points here for the US dollar, and let's bear this in mind. Also, we will start our fundamental talk with the US data, as the US dollar plays a big role in practically all Forex measures. So it is quite logical to start with American economic data and American economic background. Let's review the recent data releases from the United States for us to know what American economy has shown us at the beginning of this year, when some of us were on holidays. So last week there was a release of America's most important labor market indicator, US non-farm payrolls. This is one of the most watched Forex indicators, and of course it is very important for the US Federal Reserve, and because of that it is important for all of us who trades the US dollar. As it is in December, US economy gained 156,000 jobs. This is a smaller increase in jobs than we saw in November. Back then it was 204,000, as you may see on this chart. Still, 156,000 is a rather decent number. And if we look at our labor market indicators, we can see that average hourly earnings rose in December by 0.4%. Versus the forecast of 0.3% increase. And actually, this is the highest wage growth since 2009 in America. And these figures are really impressive. Higher wage pressure means that inflation expectations in the United States will rise. And this is the main factor why this non-farm payrolls release for December was positive in the rise of US dollar traders. We can see that unemployment rate in America increased from 4.6% to 4.7%. Still, traders were not discouraged by this news, as it turned out that labor participation rate has also increased in the United States, and as a result of more people having desire to get a job, this unemployment rate increased. So basically, it doesn't represent a negative development. It's still a positive development, meaning that the size of the US labor force is increasing. And all in all, these US labor market figures were quite positive last month, and they are in line with the path chosen by the Federal Reserve this year, the path of raising interest rates. I remind you that in December, the US Central Bank raised its benchmark rate. This rate hike was the first one in 2016. And the Federal Reserve members expect that they will raise rates 3 times in the year of 2017. Of course, these forecasts of the Federal Reserve members are not obligatory for them, so they don't have to increase rates 3 times if they don't feel like it. It's just how they view the situation, what they think will happen. I can remind you that the FOMC members' forecast for the year of 2016 didn't came true. They expected to raise rates 4 times in 2016, but actually did so only once in December. So these are just the forecasts. If we look at other US economic releases which took place during the past week, we can see that manufacturing and services PMIs by ISM were positive. They actually stayed at the highest level seen in a while, and this surely brings some confidence to US dollar bulls, because these manufacturing data represent the latest take on the US economy, the latest available data which describe the state of American economy. We also had factory orders and trade balance data for November. Here some discouraging results were published, but once again, November was rather far away, and the newer data are better than this data we had back then. So this data didn't discourage US dollar bulls much. So all in all, as the year of 2017 has started, we have a rather positive background for the US dollar. Let's see what will come next for America. And not only for America. Some insight in the highlights of this week for Forex traders, the most important releases in economic calendar. For Australian dollar, the only important publication will be the release of Australian retail sales on Tuesday. But I also advise those who trade Australian dollar to have a look at Chinese statistics like inflation figures on Tuesday and also China's trade balance on Friday. Probably Chinese trade figures will be the most important for Australian and New Zealand dollar traders as these nations are big trading partners of China. So how these countries interact in the terms of trade is really, really important for their currencies. On Wednesday, we will have the data on British manufacturing production and the regular figures on the US crude oil inventories. On Thursday, the European Central Bank will release monetary policy meeting accounts of December meeting. We can remember that to know the details of this step. Also, we will have the US unemployment claims on Thursday and some speeches of FOMC members. On Friday, we will hear from the Federal Reserve Chairwoman Janet Yellen and some other FOMC members as well. We will also have the biggest block of the US economic statistics of this week. Retail sales, producer prices, and preliminary consumer sentiment. So the most important releases will take place on Friday for America. So this is our agenda. It won't be a very intense week, but some things of importance still are here in our economic calendar. So don't miss these trading opportunities, or if you prefer not to trade on news, take these releases into account still in order to avoid them. It is a two-way trade with the news. What conclusions can we make about the US dollar? I have already told you that US economic data, which have been released so far, are quite positive, especially the US labor market data releases, NFP, which came out on Friday. And all in all, we can see that the expectations that the US Federal Reserve will be raising rates in 2017 are in place. These expectations are positive for the US dollar. Here I have put that how the market is judging the possibility of the Federal Reserve's rate hike. The data is provided by CME Group. And we can see that for now there is more or less small chance of a rate hike in March and a rather substantial expectations that the Federal Reserve will raise rates in June. Both these meetings are important because they will be accompanied by the FOMC press conferences. For now, the actual pricing in of the rate hike still isn't high, and we may still see increase in these expectations of the market, or on the other hand, a decrease of these expectations. So I suggest that we monitor this data on the weekly basis in order to track important changes in the market sentiment towards the Federal Reserve policy and consequently the US dollar. So we have these rate hike expectations. It is more or less clear. I'd like to point out that for me, 2016 and this year of 2017 seem different from the previous year, from 2016, from 2015. This year, the factor which makes this difference is that that America will have a new president who will step in on January 20th, Donald Trump. And the market is expecting much from this new figure in American politics. The market is expecting that Donald Trump will increase fiscal spending in the United States and thus accelerate the need for the Federal Reserve to raise interest rates and thus give traders more reason to buy the US dollar. So even though we can remember that last year the Federal Reserve also was preparing to raise rates in 2016, I think now the possibility that these rate hikes will actually materialize in plural, not just one rate hike, is greater because of Donald Trump and his intentions. Also, because of the fact that US inflation expectations and the US economy are now really doing much better than the previous year. So the picture is more positive for the US dollar than it was in 2016. On the one hand, the market is expecting higher rates in the US, but we still need to remember that much is already priced in since the US elections. US dollar had already made a big leap to the upside, and it might be difficult for the American currency to continue such high pace of appreciation. We currently see that the bulls remain cautious after some profit taking which took place by the year end. And as much is already priced in, the markets are practically back to the point that we have been in the middle of December when the Federal Reserve raised rates. So the market situation didn't change significantly since the middle of December. And traders are currently waiting for some further drivers for the US dollar, for some new information which will give American currency a reason to take direction, to get higher, or on the other hand, to retrace its the gains of the last several months. So as we can see from our economic calendar, the main events to look at will take place on Friday. We will have the US data releases, important data releases, and comments from the Federal Reserve Chairwoman Janet Yellen. These are the two main risks for the US dollar and its upside bullish trend right now. These risks are once again weak economic data and dovish comments from the Federal Reserve members. I think that the Federal Reserve has more or less confirmed that it is ready to raise rates. If we have a look at the FOMC December meeting minutes, which were released last week, we can see that the Federal Reserve gave an indication that it is comfortable with the market's hawkish interpretation of its interest rate forecasts. So I don't expect negative comments from the FOMC members, but I'm not so sure about the US economic data. And actually, in order to justify this rate hike approach by the Federal Reserve, US economic data have to be really good, and we have to have the majority of the US economic releases come in a positive way. Otherwise, the market may get concerned that expensive US dollar will hurt the US and global economy, and the US dollar will start to depreciate. So my outlook on the US dollar is bullish. I think that we will have a situation of no particular trend for the US dollar until Donald Trump's inauguration, which will take place on January 20th. But then we'll get more bullish trend for the US dollar, given that US economic data keep showing good results. So this is it. We have to monitor US economic data once again. This is a must for the US dollar traders. And I also have a picture here of the new members of the FOMC, the new voting members. There is a change in people who vote in the FOMC every year, and this year the change is slightly to the dovish side, but I don't think that this change will prevent the Federal Reserve from raising interest rates if the US economic data keep coming out really good. So you have to be aware of this change in FOMC voting members, but it really won't have a big critical impact on how the FOMC acts. So just for your information. And now we can switch to the charts in order to discuss the particular currency pairs and their prospects. We now start with euro dollar. And at the weekly chart, we can see that the pair is trading in the 105 area, above 105. Last week, the pair tested lows below 103.40, but still managed to close the week above 105 mark. If we look at the daily chart, we can see that on Friday there was a bearish candle formed here. The US dollar strengthened on the non-farm payrolls release, and this is a dark cloud cover pattern, which says that the bearish pressure may take place in the next few sessions. Also, this pattern was formed at the upper Bollinger Band. We can add Bollinger Band from trend indicators, and here it is. The pattern of Japanese candles was formed at the upper band. It adds credibility to this bearish pattern and makes us target levels around 105, 104.70 at least. This is the middle Bollinger Band. The lowest band is located at 103.45 area. These are the levels which are limiting euro dollar during this week. We can see that there is a resistance on the upside strengthened by 50-day moving average at 106.40. If we look at the spread between 10-year US and German yields, it has narrowed in January, and this narrowed spread is in line with the fact that the euro dollar is more or less trying to trade around 105 mark, trying to stay at these levels. All in all, European economic data were rather positive so far. Data released in Germany today showed that the nation's industrial production is good, and all in all, the leading economy of the euro area is in good shape. Inflation expectations are rising, unemployment is low, and the dynamics of industrial production is rather good. Still, there are political risks which are making their negative pressure on the euro, and also the risks tied to Brexit, which is still on the agenda for the United Kingdom. And as the areas nations also participate in the European Union. Of course, Brexit will have a negative impact on the euro as well. So this is why we have this relative stability of the European currency. But on the other hand, there are no bullish drivers for the euro. There is monetary policy divergence between the US Federal Reserve and the European Central Bank. This divergence is in favor of the US dollar, and it prevents the euro dollar from getting higher. At this daily chart, I have the weekly pivot point indicator applied to my chart. The weekly pivot indicator shows us a line painted in light blue here at 106.44. Above this line, the outlook for the currency pair is bullish. Below this line, the weekly outlook is bearish. The euro is currently trading above the pivot point, but not very strongly above, and decline below 106.44. I'm sorry, it must be the unupdated level. If you have this indicator, you should update it every week to have the actual levels. And here the pivot point is located just below 105 mark, which corresponds to the minimums of early December, late November. And if we see the euro dollar go below 105, confirmed by technical indicators, then it will be a good signal to sell euro dollar, targeting 103.75 mark. This is where the first weekly support is located. So I think that this will be a good trade. On the other hand, if we see that the euro dollar is holding above 105 mark, if we find some bullish reversal patterns on the 4-hour chart, then we will be able to expect that the euro dollar pair will visit the first weekly resistance in the area of 106.40, 106.55. I doubt that the single currency will be able to get much higher, probably only in fact if the US dollar, the US data on Friday disappoints. But we will have to wait until Friday for that. And now we see that on the 4-hour chart, trading is rather calm for the euro dollar. Actually, we see that moving averages on the 4-hour chart are horizontal, and such state of events confirms the main suggestion that the pair will continue to fluctuate between 103.75 on the downside and 106.55 on the upside. So it is more of a range trading. We can try to enter the market on its way up, but the best way to trade this thing is below 105 to the downside, around 103.75. Here probably we'll have the buyers once again, and here is a place to buy, and to sell near 106.55. So sell near this first red line. So range trading for euro dollar, as the outlook for the week is rather neutral for the US dollar and for the euro as well, and no big market movers until Friday. Let's now switch to the British pound, and we can see that this week the pound is under negative pressure, and all in all, the general downtrend in British pound continues. Still, the currency failed to retrace to the levels where it was before the Brexit vote in June. Some say that the British pound is really undervalued, but given the uncertainty which surrounds the Brexit process, simply the uncertainty prevents British pound from trading on better economic data we get from Britain, and we see that traders keep selling this currency. Theresa May, the head of the UK government, said on Sunday that negotiations on Brexit will be about getting the right relationship and not about keeping bits of the UK membership in the European Union. These comments were taken negatively by the market, and we saw GBP USD decline towards 1.2150 mark. We await the ruling of the UK Supreme Court on Brexit. This ruling is expected somewhere between January 12th and January 17th. And the thing is that the UK Supreme Court will decide whether the British government needs approval of British Parliament to start Brexit. If the court says that it does, then the British pound will have some additional support, and we will probably see a positive weekly dynamics as in this case Brexit will get delayed. But if the court says that the government doesn't need the approval of the parliament to trigger Article 50 and Brexit, British pound will once again suffer. Still, some analysts say that it is not really important. Now, everyone believes that Britain will ultimately leave the European Union, and it is more about conditions on which the UK will take part in the European single market or not, which are really important. So for now, we have this pressure on the British pound, and in my opinion, bullish positions here are quite risky. Getting to the daily chart, we can see at the technical picture there was a rejection of the British currency from 50-day moving average located at 1.2435. Here we have a bearish engulfing pattern. Trading today opened with a gap to the downside, and as a result, the technical picture on the daily chart doesn't look very encouraging, and we have levels around 1.20 to watch next. Here I have this weekly pivot indicator. We can see that the pivot mark for the British pound is located at 1.2305 level. This is a major resistance for the British pound this week. Around this level, if the pound managed to return to 1.2305, new sellers should appear here, keeping the currency under pressure. And the next target to the downside lies at 1.2070. This is my bearish target for the British pound. If something happens and if there are very negative comments from the UK officials, if US dollars suddenly feels stronger, then we have another level at 1.1945, but I think that this may be too much for this week, and we need to focus on closer levels around 1.2070 as our targets. Also, let's have a look at our next important currency pair, US dollar Japanese yen. On the weekly chart, we can see that the pair keeps consolidating. Last week, there was a very uncertain candle with long upper shadow and long lower shadow and a very small body. It shows that the market is undecided, that the pair keeps consolidating. It is not yet ready to hit the next Fibonacci level of 78.6% from the decline of 2015-2016. This level is located at 120 mark, and the level of 61.8% Fibonacci at 115.50 is acting as support, as well as 100-week moving average at 114.70. This is a pretty good support, and as long as we stay above these levels, the chance that dollar yen will hit higher levels are still in place. Fundamentally, we still have monetary policy divergence between the Federal Reserve and the Bank of Japan. The Bank of Japan's policies are weakening the yen. We saw that very clearly in December, and the situation is going to continue. So it is a question of time until dollar yen hits 120 mark. This movement of the pair to the upside still looks unfinished for me, and I expect us to see higher levels. So on the daily chart, we can see that there was an attempt to get below 100.50 last week, but the positive US labor market data made the bulls correct to the upside. Here is the piercing line formation, which is bullish, of these two big candles, and this failed attempt to break below 115.50 adds credibility to this level as the market support. So I expect the outlook for dollar yen this week will be rather neutral, be above 115.50 on the downside, but below 118.50 on the upside, probably even limited by resistance at 117.50. We can see that the daily technical indicators are not very positive. They show that this advance of the dollar yen has lost momentum. Moving averages are still in the positive intersection, still show that the overall uptrend is in place, but the consolidation and correction of the pair still hasn't finished. So we will be trading buying dollar yen around 115.50 and probably selling around 117.50. On the 4-hour chart, we can see that the pair is getting ready to test lower levels to get once again to 115.60, 115.50. But here we will have support of 200 period moving average and around 170, where are 150 period moving averages, which show that momentum to the upside has decreased, and the main trading will take place between this green line and this yellow or orange line. So this is the place where dollar yen will likely spend this week. We won't have any important data releases from Japan, so probably the biggest newsmakers will be coming from the Federal Reserve's members and also US data, which will be released on Friday. Let's now move to commodity currencies and to our first currency, Australian dollar versus the US dollar. On the weekly chart, we can see that after testing levels near 0.7160, we managed to recover to levels above 0.73. I think that this recovery of the Australian dollar represents nothing more than correction to the upside, and that this correction will soon meet resistance. We know that Australian economy is not in particularly good shape. Australian GDP contracted in the third quarter, and in my opinion, markets will soon start pricing in higher possibility of Australian rate cuts this year. So given taking into account the general strength of the US dollar, I think that Australian currency will meet resistance. We see that there are obstacles in form of moving averages around 0.7437. And if we look on the daily chart, we can see a cluster of daily moving averages around 0.75 and lower at 0.7413. We can also draw a trend line through the recent highs. And this is where the pair has currently found resistance. This is the level of 0.7360. So let's put it on the chart. This is a significant resistance for Australian currency, and I think it is risky to buy Australian dollar above these levels, as there are several resistance levels between here at 0.7360 and 0.75. On the other hand, the confirmation that the pair will stay below 0.7360 will give us a chance to retest 0.72 mark, which is a support for the pair. So here we will set our take profit levels, take profit orders on our short positions. On the 4-hour chart, we see some positive signs, but still see the existence of resistance near 0.7340. So we will watch for the development of this trade pattern, but the preferred direction to enter the market is to the downside, to sell Australian currency versus the US currency. So this is it of what we were talking about today. So it is the start of the new year. Forex traders have returned to the market, and we see that the amount of liquidity is being restored. Also, we can see that the US dollar suffered some correction to the downside by the end of the year. Traders took profit on their bullish US dollar positions, but large speculators are rebuilding their bullish bets on the US currency. Also, there were good statistical data from the United States. So for now, there are no reasons to expect that the US dollar will lose support and will fall down rapidly during the next trading sessions. The main events for the American currency this week will take place on Friday. I mean, the speech of Federal Reserve Chairwoman Janet Yellen and the release of American statistics like retail sales and producer prices. They will be very important. All in all, the focus will be on American economic data, and it should be really well for the market to find a new bullish driver for the US dollar, as we know that some expectations of high rates in the United States are already priced in America's currency exchange rate. So we need for American economy to keep fueling this US dollar rally. If we are talking about the picture for the American dollar in Forex major currency pairs, we can say that the euro dollar is still vulnerable to the downside. Decline below 105 will open the way to decline to 103.75. But if we manage to stay here, then we'll get trading between 105 and 106.50. This is the ceiling for the pair on the upside, and we have to be range traders for the euro dollar this week. For the British pound, the picture looks negative, and our target lies at 1.2070. Next target is at 1.1950. All in all, the pound is still affected by the uncertainty which is surrounding Brexit. And on the daily chart, we have strong resistance at 1.2410, recoil down from this level. And I think that bears will dominate at this market. For dollar yen, the overall trend remains bullish. Picture is quite positive, but the bullish momentum has slowed down, and we expect further consolidation between 1.1850 on the upside and 1.1550 on the downside. And if we're talking about Australian dollar, then I'd like to tell you that bullish positions are still risky. We have resistance at 0.7360 and further resistance at 0.75, but in between there are also some important resistance levels. So the preferred direction to trade is on decline below 0.73 with targets at 0.72. But given the fact that there are some bullish developments on the 4-hour chart, we can still experience some short-term reaction to the upside, and maybe some small position sizes of bullish bets above 0.7360 are possible with take profits around 0.7450 if we are conservative traders. This is my take on the current week. I'll be very glad to see you in a week from now, and we'll see whether the forecasts manage to come true, and we'll discuss the further outlook for the major forex currency pairs. Thank you for your attention. It was Elizaveta Belugina, and it was a webinar by FBS. See you next week, and have a great trading week and a great start of 2017.